Starting now. Hello, everyone, and welcome to the first live event by Guideway Financial. Today's topic is tax hazards and opportunities. We wanted to go over some tax information. Sometimes taxes are not the most exciting topic to people, but we like to talk about tax strategies. The reasons are that to some extent, you can often control your tax situation and make an impact upon your finances in a positive way. And the other reason is that taxes affect retirement more than most people realize. So Jim will begin today by talking about tax strategies in retirement, and then I will follow with some curated information about some tax legislation that passed late in 2022 and may provide some opportunities. All right, Jim, ready for your portion.
Thanks, Sharon. So in retirement, there are three tax hazards. There's Medicare, there's Social Security, and worst of all, there's surviving. The first hazard of Medicare comes in the form of IRMA. IRMA is short for Income-Related Monthly Adjusted Amount. It's an increase in your Medicare premiums based on income. In other words, it's an income tax collected by the Social Security Administration instead of the IRS. These premium increases are triggered by crossing certain income thresholds. So as an example, consider Fred and Ginger. They're both age 65 and they're not receiving any Social Security yet. Their income, if their income is up to and including $194,000, the IRMA penalty will be $0. If they make more than $194,000, then their IRMA penalty is $1,874. So if they make $1 more, in other words, that $1 increases their IRMA penalty by $1,874. If they go all the way up to $246,000, the IRMA penalty doesn't change at all. But if they cross that $246,000 threshold, their penalty goes up to $4,712. The next threshold is at $306,000, and it goes up to $7,546, and then at $366,000, the penalty goes up to $10,382. So you can see that these are very, very expensive dollars, and you want to avoid those dollars if possible. You don't want to just accidentally cross over and then buy a few dollars and then have to pay these penalties. Let's imagine, though, you're considering crossing the threshold. Maybe you need some extra cash pulled from your taxable IRA. So if you cross the first threshold, the 1874 threshold, this is equivalent, that first dollar, the marginal tax rate on it is equivalent to 187,400%. If you cross it by $2, you divide that 1875 or 1874 by 2, and so you're paying a rate of 93,700%. At $4, it drops to 46,850, and now you're starting to see real bargains. You know, if your marginal rate is only 47,000%. But if you really bump this up to a large amount, say about $50,000, then the marginal rate on that IRMA, or the average rate on that IRMA rather, is 3.75%. So it starts to get smaller and smaller if you cross it by large amounts. Now, keep in mind that this is on top of your other income taxes. This is just for the IRMA. But the lesson here is that if you're going to cross the IRMA, you might as well cross it by a lot, depending on what's going on with your other income taxes. So now let's consider the second penalty, and that's going to be, or the second hazard, that's Social Security. Fred and Ginger are now 70 years old, and they're ready to start their benefits. Each of them are going to receive $3,000 a month, or a total of $72,000 per year. So how does this affect their marginal tax rates? Let's assume that their other income is $17,000. We can see that before starting Social Security, they don't pay any taxes, but after Social Security, their marginal tax rate goes to 18.5%. So the IRA income is more expensive after they start taking Social Security than it was before taking the Social Security. Similarly, at at $30,000 of other income, they go from 0 to 22%, and at 70,000, it goes from 12% to 41%. That is very painful. So what we can see from this is that taking money out of your IRA after Social Security starts is a lot more expensive than taking it out before your Social Security starts. And that's not all, though. There's a bonus. Oops, let's see here. The bonus is that the IRMA thresholds are also reduced in terms of your IRA income. The third hazard is survival. Now, let's assume that Ginger survives Fred. Their total Social Security benefit drops from $72,000 to $3,600. So her income is dropping substantially. How will this affect her tax bill? Well, if their other income is $25,000 when they're both alive, and their taxes will be $1,475 for the year. If Ginger survives, her taxes go up to $2,354. It's up $879. That's a 60% increase. Even though her income has dropped by 37%, her total income goes from the 25 plus 72, which is 97,000. It drops down to 25 plus 36, which is 61,000. That's a 37% drop in income, but a 60% increase in her taxes. At the other income levels, at 45,000, then her taxes go up $2,397 or 42%, and at $70,000, her taxes increase $2,748 or 23%. So we can see that Ginger's income drops substantially, but her income drops substantially, but her taxes increase substantially as well. The bonus again here is the IRMA thresholds are cut in half, so she's much more likely to pay IRMA penalties on top of her other taxes. So let's assume in this case, we'll summarize all the hazards. And in this example, this case, the couple is drawing $195,000 from their IRA each year, and we're going to go through each of the stages of their retirement. In the first stage, they are not receiving Social Security and they're not on Medicare. Their taxes are going to be $27,421. When Medicare begins, their taxes go up to $28,635. And then after Social Security begins, their taxes go up to $45,632. Finally, when one of them passes away, the survivor's taxes increase to $51,191. So the important thing is that each stage increases their taxes, and this results in the lesson here is that you want to take your taxable income when the rates are lower, and you want to shove some of that income earlier into your retirement if possible. So how do we do that? We do that through tax smoothing. Tax smoothing seeks to keep the marginal tax rate steady over the years, and this will increase your overall. This will reduce your overall taxes and increase your total after-tax income. It does this by shifting your income from the high tax years to the low tax years, and it's a multi-year strategy. You can't just do it once year and you're done, one time and you're done. You've got to do it for several years, and if you can start it before retirement, that it could be even better. So again, Fred and Ginger here. In this particular situation, they retire when they're both 60. Medicare starts when they're 65. Fred passes at age 80, Ginger at age 96. They have $1 million in a taxable IRA or a traditional IRA and $1 million in a bank savings account. They want to spend about $110,000 per year after taxes, and their Social Security benefits are going to be the same as the other examples at $3,000 a month each, or $72,000. combined per year. So here's a chart of what their taxes are going to look like over time. The light green area here, let me get my laser pointer here. The light green area here are their after-tax, are their tax-free withdrawals from their savings account. The dark green area is the taxable withdrawals, and this includes the dark red area above here. So the dark green is their taxable withdrawals from their IRA. So they're withdrawing this much. The light blue area is their Social Security benefits, and the purple line here represents their after-tax income. So you can kind of see that they're pulling out a lot of money right here, about $120,000, but they're paying about $10,000 in taxes. So their after-tax income is about $110,000. That's the target income that we're shooting for. When the savings are depleted here, they begin their IRA withdrawals. That phases in, and then they reduce their IRA withdrawals once the Social Security benefits begin. And this is how they maintain this $110,000 after-tax income. Unfortunately, their IRA withdrawals are forced to go higher because of required minimum distributions, and so their income gets pushed up, and their taxes increase a little bit as well. Once Fred passes, the Social Security income drops, but Ginger's taxes go up substantially. Look at how much larger her taxes are. And her after-tax income drops, though, and it drops below the target of $110,000, because if Ginger takes out enough to cover her $110,000, she's going to run out of money. And so she has to reduce her IRA withdrawals to keep her and reduce her after-tax income. Now, with smoothing, the scenario looks similar, but there are some important differences. First of all, we add Roth conversions in the early stages of retirement. This increases their taxes during this period, but when the IRA withdrawals begin, the taxes are reduced. The withdrawals are reduced and supplemented with these tax-free Roth withdrawals. Once the Social Security benefits start, the IRA withdrawals are reduced further, and then after Fred's passing, the IRA withdrawals are reduced again, but most of the income shortfall is made up for with the Roth IRA withdrawals. So you can see that the taxes get smaller and smaller over time. That doesn't mean that their marginal tax rate is changing. We're actually trying to keep the marginal tax rate relatively similar, or as similar as possible across all these periods. So what does this look like when we add everything up? In the no smoothing situation, their after-tax income is about $3,885,754. Their IRA balance at the end of Ginger's life is $91,425, and so the total income plus the balances is $3,977,170. The taxes paid on that over their life is $406,000 roughly. With smoothing, their after-tax income is $3,968,006. So the difference is about $82,000. The ending IRA balances, however, are substantially higher, and here we have the traditional IRA is about $41,000 higher, and the Roth end balance is $219,000 higher because there was no Roth in the first scenario. And so at the end of Ginger's life, with smoothing, her total income plus the ending balances is $342,000 or more. And her taxes, or their taxes over their lifetimes, would be reduced by about $311,000. So that's how this works out. I don't know, Sharon, if we can open up for questions at this point, but if not, we'll move on to the next thing.
Well, on that note, our intent was to have Q&A opportunity with this live event. However, from what I'm seeing on my end, it is not allowing us to open up that Q&A. Jim, I don't know if you see a control possibly on your end that would open it up, but for some reason it is not available on mine. So we may, if we cannot open that up for Q&A, then we may just need to ask the participants if they do have some questions about this information to just send us an email and we'll be happy to get back to them.
Okay. Do
you see a way, Jim, to open up the Q&A?
No, I think it has to be in the on the website.
Yeah, so unfortunately, we must not have checked the correct box on that piece. Apologize for that. So we will not be able to have the Q&A live. So, but feel free, please, to email us if you do have questions. You can email Jim at jim.lear@guidewayfinancial.com or myself, sharon.lear@guidewayfinancial.com. But for now, I'm going to continue with the next section of the presentation, which is my portion to speak about some of the new tax opportunities that have arisen due to the Inflation Act of 2022 and Secure Act 2.0 of 2022. The Inflation Act was passed a few months ago, and then the Secure Act at the very, very end of 2022. There are a lot of provisions in each of these pieces of legislation, and it's not possible to cover every aspect. We do have some handouts. Again, we're happy to provide those. If you'd like a copy, just let us know. But we have some handouts on both. And if anyone would like to dive into a lot more details, the handouts are not terribly long, so they don't take a super long time to read, but if there's information that is of interest, then I would suggest asking us for a copy of those. Nevertheless, so I've curated just a handful of things that may apply to a lot of people, just if you're a homeowner or a vehicle owner and those sorts of things. So I'd like to just step through a few of those right now because these may offer some opportunity to assist your taxes basically going forward. So for the Inflation Act, Reduction Act of 2022, the first is the Energy Efficient Home Improvement Credit. This is similar to what was available previously. One of the main differences now is that the credits apply to any residence that is owned by the homeowner, not just the principal residence. So this opens up the opportunity that if you have a vacation home, that you can also apply for some credits for that vacation home, not just for your principal home. The credit itself is 30% of the improvements, and so that's nice. Another provision that has changed about it is that previously there was a $500 lifetime maximum. Now that has been changed to a much more generous $1,200 annually that's available. There are certain limitations, as you can see listed on the slide, for various improvements that are specific. And so again, I encourage anyone who is interested in pursuing one of these types of credits or provisions to dive into the details and make sure that you know all the rules. This one is effective now, and it should run through 2034. The next provision is the Residential Clean Energy Credit. This one actually increases the credit for solar, fuel cell, wind, and geothermal heat pumps. Again, it's 30% of the amount that's placed in service. And one of the newest things that may be of interest is the qualified battery storage technology for you Tesla owners or other EV vehicles. So this one is already in place as well. Some of the provisions started in 2022. Qualified battery is starting here in 2023, and then the whole provision runs until 2034. On a similar note, for your vehicle itself, there is the Clean Vehicle Credit. There was already a Clean Vehicle Credit in place, and the amount is the same, the maximum credit of $7,500. However, now there are certain aspects that must be satisfied. for each half of that $7,500. You see here that there's a critical minerals requirement as well as the battery components requirement. So another aspect that is new to this rule this year is that the final assembly must be in North America. I believe that piece was actually implemented in last August, if I'm remembering correctly on that. But one of the other interesting aspects is now they've eliminated the phase out upon the sale of the 200,000th vehicle. Some of you may recall that there was a limit to the number of vehicles that could obtain the credit based upon when the manufacturer reached that 200,000th vehicle. But that has been eliminated. But instead, there is now there are some income limitations. So basically, your income must meet the amount that you see here on the slide, and not go over that amount, or you're not eligible for the credit. So for married, can you go back to? Oh, sorry, there we go. For married filing joint, that credit is a modified AGI of, if your modified AGI is below 150,000, then you're eligible for the credit. And if you're single, it must be below 75,000. I'm sorry, no, we're flipping slides here. I'm sorry, it's 300,000 for modified filing for married filing joint, and it's 150,000 for single. There's also a cap amount on the amount that the vehicle itself costs. So the vehicle must be below 80,000 for a van, SUV, or pickup truck, or below 55,000 for any other vehicle. Another new thing that has entered the picture is there is now a previously owned clean vehicle credit. So you may now purchase a used vehicle and receive some degree of credit for that. It's either the lesser of $4,000 or 30% of the sales price. There are some rules associated with it. The model year of the vehicle chosen must be no more than, it must be at least, 2 years older than the purchase year. So this is going to slide according to what year that we're in, because the credit extends for a number of years, but that model year must be at least 2 years older than the current year. It also, the vehicle must be sold by a qualified dealer, so you're not going to be able to go purchase a vehicle from another owner. It must go through the dealer itself, and the sale price of the vehicle must be below $25,000. Again, there are some income limitations that are listed here on the slide that you can see. Another major change that came in with the Inflation Reduction Act was there are some changes that are going to happen with Medicare prescriptions. And what they're trying to do is reduce the cost of prescriptions. So we'll have to see how this plays out, and if it works, we certainly hope that it does. But this is one area where we do have a handout that goes into more detail. But there's going to be a yearly cap starting in 2025 on the out-of-pocket drug costs, limiting that to $2,000. There will also be an option to pay monthly, because for those of you who are already on Medicare and have experienced this, you know that there are a lot of ups and downs with the way that the pricing is done in terms of whether you've met the deductible, whether you're in the donut hole or not in the donut hole, and it causes the cost of prescriptions when you're on Medicare to vacillate widely throughout the year. So there is going to be an option to pay monthly to hopefully smooth that out. The other thing that they're trying to do is just to see if they can lower drug prices by opening up price negotiation with the manufacturers. This will start in 2026, and it won't include all drugs all at once. They're going to phase in 10 to 20 drugs each year, so it will take a while before all of this begins to occur. Another aspect of this act is, or this provision, is that insulin itself was named out specifically and being capped at $35 a month if you have traditional Medicare. So there will also be some drug maker rebates to the federal government that will be required if price increases that exceed the rate of inflation starting in 2025. So hopefully, some of these things will begin to take effect, but it is going to take, I think, a number of years before we see some of the prices affected by this. But hopefully, like I said, hopefully it works. Another, I guess this is moving on to the Secure 2.0 Act. And some of you may remember we had a couple of years ago the Secure 1.0 Act. Secure 2.0 actually has about 10 times the number of provisions in it that Secure 1.0 did. So I've really only, picked, like I said, a few to discuss here today. One of them is the increase in age for required minimum distributions from an IRA. So RMDs, for short, are required for all IRAs and qualified retirement plans, such as 401ks and 403bs. And there's an age at which the required minimum distributions must begin. Usually, or in the way that this works is that the first RMD is due on April 1st of the year after reaching that retirement age, that required age. And then another RMD is due by December 31st each year thereafter. So those were standard rules. But what we've seen is that the Secure Act initially changed that RMD age from 70 and a half to age 72. That began in 2020. The CARES Act then came along during the pandemic, and they were trying to provide some relief during the pandemic for people who didn't really need that money so that they could forego the RMD in 2020. So CARES Act came in and said, okay, for 1 year, you do not have to take an RMD. Now, the Secure Act 2.0 is coming in and saying that the age is being raised to a required minimum distribution starting in 2023 if you are age 73 and going to age 75 in 2033. So it's all very confusing if, with all these changes, but they're trying basically to gradually raise the age by which people are required to start taking those RMDs. This is good for folks who do not necessarily need to rely upon their IRAs in the early part of retirement, and it also helps to open up the more opportunities, say, to do Roth conversions by keeping your income at a lower level in the initial years of retirement. So there are some strategies that can be followed based upon this rule or this change. The next point that I wanted to highlight from the Secure Act is the reduction in excise tax on, as they put it, certain accumulations and qualified retirement plans. What this means is that if you forgot to take your RMD, there used to be a very hefty penalty. It was 50% of the RMD amount. And so a lot of people got caught by this because they didn't necessarily know that they needed to start RMDs, or they didn't calculate it properly. Believe me, there are a lot of mistakes when it came to RMDs. And so now, seeing this, they've reduced the penalty to 25%, but it's even possible that a further reduction to 10% is allowed if the shortfall is corrected within a certain correction window, which is roughly about 2 years. So this is a good provision, I think, that will help people out when they just make a simple mistake on their RMD. Another aspect of the Secure 2.0 that may be of interest involves 529 plans. So basically, the provision itself is saying that rollovers from long-term QTP or qualified tuition plans is allowed now to Roth IRAs. So if you have someone, say a child or maybe a grandchild or whomever that has a 529, if they for some reason ended up not utilizing that 529. Maybe they didn't go to college. Maybe they went to college and got scholarships. Who knows what the reasons could be? Maybe you saved for them to go to a private school, but they ended up going to a public university and didn't need all that money. Well, now it's possible to roll that leftover 529 money over to a Roth IRA. There is a $35,000 lifetime limit. And it is also subject to limitations, standard limitations on the annual contribution limits that you can gift to someone. So that's basically for 2023, that's $17,000. There are other details. So again, I encourage anyone who wants to look at this to pay attention to some of those details. Qualified charitable distributions, or QCDs. These are distributions that you can make out of an IRA account straight to a charitable organization. It is a tax advantageous way of donating to a charity. QCDs have existed for some time, but there are a few changes that that are occurring with them. Basically, the previous limit was $100,000 per year. Now that is going to be adjusted annually for inflation. And there's also a change in that a one-time QCD of $50,000 is allowed to what is called a split interest entity. And these don't necessarily apply to everyone, but sometimes people, as part of their estate plan, may have things like a charitable gift annuity or a CRUT or a CRAT that is set up as part of their estate plan. And so this is another provision that is different going forward. There are a lot of other provisions as part of the Secure Act 2.0. I've listed a few here. I'm not going to go through each of these, but we will provide copies of the handouts to anyone who would like, plus not only just copies of the slides, but also the other handouts I mentioned. So if you'd like a more detailed summary, I have my email address right there. Jot it down, and I'm happy to provide that information. So that is everything that we have for today. We appreciate your attending our webinar, and please let us know if there are any other topics that you might like to cover in the future. We hope to continue this webinar or live event in future months, and would really appreciate any input that anyone has. Jim, do you have any comments before we go today?
No, again, sorry, we don't have this set up for questions and answers. We we'll look at that in the future for these things. And again, like Sharon said, if any of you have questions or feedback, we would love to hear from you. You can give us a call or you can email us. So we do appreciate it.
Bye-bye, everyone.